To defer means to postpone or delay. Deferrals are expenses or revenues that are recognized at a date later than the point when cash was originally exchanged. The two types of deferrals are prepaid expenses and unearned revenues. Before we talk about deferrals, let's review some of the transactions from the previous chapter. On October 2nd, Pioneer purchased office equipment costing $5,000 by signing a 3-month note for 12%. This resulted in an increase or a debit to equipment and a credit to notes payable. They also received a $1,200 cash advance from a client. Pioneer has a liability to the customer until they perform the service. When they perform the guided tour, they can record revenue. So on October 2nd, we identified that we received cash. We also identified an unearned service revenue in the amount of $1,200. Pioneer paid $600 for a 1-year insurance policy that will expire next year on September 30th. This resulted in a debit to prepaid insurance and a credit to cash. They also purchased an estimated 3 months of supplies on account. This transaction increases both an asset, supplies, because they are available for future use, and a liability, accounts payable. In each of these transactions, we deferred or postponed revenue or an expense item. We need to make adjusting entries to record the portion of expenses that was incurred, as well as any revenues earned during the period. When companies record payments of expenses that will benefit more than one accounting period, they record an asset called prepaid expenses. Examples of common prepayments are insurance, supplies, advertising, and rent. In addition, companies make prepayments when they purchase buildings and equipment. When expenses are prepaid, an asset account is increased to show the benefit that the company will receive in the future. When the expense incurs, we must increase the expense and decrease the asset. Prepaid expenses are costs that expire either with the passage of time, such as insurance, or through use, such as supplies. The expiration of these costs does not require daily entries. That would be impractical. So companies postpone the recognition until they prepare financial statements. At each financial statement date, they make adjusting entries to record the expense and adjust the assets. An adjusting entry for prepaid expenses results in an increase or a debit to an expense account and a decrease or a credit to an asset account. The purchase of supplies, such as paper and envelopes, results in an increase or a debit to an asset called supplies. During the accounting period, the company uses supplies. Rather than record supplies expense as the supplies are used, companies recognize supplies expense at the end of the accounting period. At the end of the accounting period, the company counts the remaining supplies. The difference between the balance in the supplies account and the cost of supplies on hand represents the supplies used during the period. Pioneer purchased supplies costing $2,500 on October 5th. Pioneer recorded the purchase by increasing or debiting the asset supplies. This account shows a balance of $2,500 in the October 31st trial balance. An inventory count at the close of business on October 31st reveals that $1,000 of supplies are still on hand. The cost of supplies used is $1,500, which is simply the difference between $2,500 and $1,000. The use of supplies increases or debits supplies expense and decreases or credits supplies for $1,500. After the adjustment, the supplies account shows a balance of $1,000, which is equal to the cost of supplies on hand. And the supplies expense shows a balance of $1,500, which equals the cost of supplies used in October. If Pioneer does not make the adjusting entry, expenses are understated and assets are overstated. Companies purchase insurance to protect themselves from losses due to fire, theft, and unforeseen events. Oftentimes, insurance must be paid in advance, such as 1 year. The cost of the insurance paid in advance is recorded as an increase or a debit to prepaid insurance, an asset account. The adjusting entry needs to increase or debit insurance expense and decrease or credit prepaid insurance for the cost of insurance that has expired during the period. Pioneer paid $600 for a 1-year insurance policy. Coverage began on October 1st. Pioneer recorded the payment by increasing prepaid insurance. This account shows a balance of $600. Insurance of $50 expires each month, and that is found by taking the $600 premium and dividing by 12 months. The expiration of prepaid insurance increases insurance expense and decreases prepaid insurance by $50, and we will make this entry every month. Prepaid insurance shows a balance of $550. This represents the unexpired cost for the remaining 11 months of coverage. At the same time, the balance in insurance expense equals the insurance cost that expired in October, which is $50. If Pioneer does not make this adjustment, October expenses are understated and assets will be overstated. A company typically owns a variety of assets that have long lives, such as buildings, equipment, and motor vehicles. These assets are expected to provide services for many years, so they are recorded as an asset rather than an expense when acquired. These assets are used over time to generate revenue, so some of their cost should be recorded in the same period so that we follow the expense recognition principle. Depreciation allocates an asset's cost to the periods in which it's used. For example, if we purchased a truck for $60,000 and we expect to use it for the next 6 years, and let's assume it has no value at the end of its useful life, we would recognize depreciation expense of $10,000 for the next 6 years. Depreciation does not attempt to report actual changes in the value of the asset. For Pioneer, assume that depreciation on the equipment is $480 a year or $40 per month. This results in a debit to depreciation expense. To keep track of the asset's cost, the amount that has been used does not decrease the asset. Instead, we use accumulated depreciation equipment. Accumulated depreciation is a contra asset account. Contra assets are linked to another account but have the opposite balance. The accumulated depreciation equipment account offsets the asset account equipment. This account keeps track of the total amount of depreciation expense taken over the life of the asset. On the balance sheet, Pioneer deducts accumulated depreciation equipment from equipment. Book value is the difference between the cost and its related accumulated depreciation. In this illustration, the book value of equipment is $4,960. Lastly, the balance in the accumulated depreciation equipment account will increase by $40 each month, and the balance in equipment remains at $5,000 or its cost. When companies record payments of expenses that will benefit more than one accounting period, they record an asset called prepaid expenses. Prepaid expenses are costs that expire either with the passage of time, such as insurance, or through use, such as supplies. An adjusting entry for prepaid expenses results in an increase or a debit to an expense account and a decrease or a credit to an asset account. When companies receive cash before services are performed, they record a liability called unearned revenues. because the company has a performance obligation to provide a service to a customer. Items like rent, subscriptions, and customer deposits for future service result in unearned revenues. If you remember from the previous chapter, I explained this concept using Southwest. When you purchase a ticket for Southwest, you typically buy it months in advance. When you give Southwest your money, they increase both cash and a liability called unearned service revenue. Southwest will recognize revenue and reduce the liability when they provide the service or take you to your destination. As I just stated, when companies receive cash before services are performed, they record a liability called unearned revenue or unearned service revenue. Recognition of revenue is deferred or postponed until the company meets the obligation. Once it does, the company records the revenue and reduces the liability. The adjusting entry records the revenues earned during the period and shows the liability that remains. An adjusting entry for unearned revenues results in a decrease or a debit to a liability and an increase or a credit to a revenue account. Pioneer received $1,200 from a customer for services to be completed by December 31st. Unearned service revenue shows a balance of $1,200. From an evaluation of the service Pioneers performed during October, the company determines that it should recognize $400 of revenue in October. The liability, unearned service revenue, is decreased with a debit, and service revenue is increased with a credit. The liability, unearned service revenue, now shows a balance of $800. This represents the amount of services expected to be performed in the future. Companies record cash received before services are performed by increasing or crediting a liability account called unearned revenue. Examples include rent, subscription, and customer deposits. The adjusting entry debits a liability and credits revenue.